In fiscal policy, you're going to be changing government spending or taxes to affect overall spending or aggregate demand to help stabilize the economy. But which should you do? Should you choose government spending or should you choose taxation? Well, it depends. And it turns out the size of the multiplier for each of these is totally different. Well, maybe not totally different, but different. So the question is the spending versus the tax and transfer multiplier, which is stronger? So here's a scenario. You're a policymaker and you're charged with helping to stabilize the economy during a downturn. You're going to be using fiscal policy to help stabilize aggregate demand, so you know you're going to shift the aggregate demand curve, and you're going to shift it up if it has fallen, and vice versa. In this case, you want to shift it up because you have a downturn, right? So recession is what the reality is. You need to push up spending to stabilize against the drop in spending that probably happened. But how much should you do? So here's a useful question. If you've got a $500 million policy, will it have the same effect if it's a government purchase increase compared to a $500 million tax cut or increase in government transfers? And the answer is it will be different. So let's figure out which will have a more powerful impact. All right, so first let's talk about the purchase of government services. So if government purchases goes up by 500 million, we know what to do with that, right? We know that this will create a larger increase in spending by the amount of the multiplier. The spending multiplier is 1 over the MPS, right? So what we would do is we'd take this 500 million, multiply it by 1 over MPS, and we'd get our end result, right? So let's assume that the MPS is 0.2. That gives us a multiplier of 1 over 0.2, or 5. And so our end result will be 2,500, or 500 times 5. And now let's run that same experiment if we, instead of government purchases, if we do tax cut of 500 million, which, by the way, is equivalent to this idea of government transfers. A government transfer is a gift of money to an individual for which nothing is received in return. So in both the case of the tax cut and the government transfer, money is going from the government directly into somebody's pocket before it hits the economy. So it's indirect compared to government purchases, which go directly to the economy. This takes a pit stop in someone's pocket, but before. So if we have a tax cut of $500 million, or a transfer of increase in transfer of 500 million, there's going to be also a larger increase in spending. The multiplier doesn't go away, but how big is it? Well, let's figure this out. If we have 500 million, and we know the spending multiplier is in the same data here, 0.2, so this would be 5. You get 2,500, but remember that 2,500 really only hits the person's pocketbook and doesn't go directly into the economy. In fact, $2,500 in pockets, of which 80% is spent. How do we know 80%? Because we know that MPS is 0.2, so the MPC must be 0.8. In other words, if we're spending 80% and saving 20%, a tax cut or transfer increase of $2,500 is only going to be spent to the tune of 80%. So in other words, this whole thing has to be multiplied by the MPC to figure out how much of that tax cut actually gets into the economy. If you want to add those terms together, right, we've got the MPC in this case is 0.8. So to figure out the impact of this tax cut, it's 0.8. And I'm just going to combine the terms here over 0.2 times the 500 million. You'll see what I'm doing in just a second. That gives us, this 0.8 over 0.2 is 4 times 500 million. And that is 2,000 million. So the impact of the tax cut is less than the impact of the spending increase, and that is because the tax multiplier is this 0.8 over 0.2, or in other words, this, right? If the spending multiplier, so bear with me here for just a second, the spending multiplier is 1 over the MPS, and the tax transfer multiplier is that times the MPC, right? And then we multiply that by whatever the actual policy is, like in the last example, 500 million. You can combine these terms, right, to this, MPC over MPS. Usually we put a negative sign in front of it just to remind ourselves if it's taxes, that to cut taxes you're going to increase spending and vice versa. But the key point is your tax and transfer multiplier, which is this, is smaller than the spending multiplier, which is this, right? Any two numbers you get, let's say MPC is 0.9, let's change up the numbers a little bit. That would make your MPS 0.1, right? So your spending multiplier is what? 1 over 0.1 or 10. Your tax transfer multiplier is 0.9 over 0.1 or 9. So how do we interpret that? For every dollar of fiscal policy that we do, we get $10 of extra spending if we do it via changes in government spending directly, but we only get $9 if we do it via taxes and transfers. So dollar for dollar, you get more bang for your buck by changing government spending than you do by changing taxes and transfers. So back to the original question, which of these two multipliers is stronger? The answer is going to be spending. Yay, spending multiplier.